Good morning. I hope everyone enjoyed the long holiday weekend. I'm Jonathan Osmo, Assistant Executive Director of Member Services, and I'd like to welcome you to today's retirement webinar, Your MTRS Benefits, brought to you by the Massachusetts Teachers Retirement System. We're very happy to be here today, virtually, of course, to present this webinar to all of you. At the MTRS, we strive to serve you, our members, in the best way possible at all times. So that's why, in part, we're presenting this webinar for you today. We know retirement is a big deal. It's one of the most important life decisions that you'll make, like going to college or getting married. And just like anything else, remember the 5 Ps. Proper planning prevents poor performance. So of course, that's why you're here with us today, so you can properly plan for your retirement. Throughout this presentation, we'll stop to answer a few questions from the entire group. You can ask questions through the Q&A feature of the webinar. And if we don't answer your question in front of the whole audience, we have staff here who will individually answer your question by responding to you through the Microsoft Teams app. Now, before we start the presentation, I just want to take a minute to introduce the booklet. I know you didn't receive an actual printed copy of the booklet, but by registering to today's webinar, you received a PDF version of our program booklet. We updated it for 2023, and we expect to receive the printed copies in our office shortly. But this booklet follows this presentation exactly, slide for slide. It also contains much more information in the margins and resource information at the back of the booklet. In fact, I would consider this booklet to be our best printed resource for information. Of course, our best resource for information is our website, and we'll talk more about that in the presentation. So we've broken this presentation into 5 parts. In part 1, I'll take you through an introduction of the system, what we do for you, some resources that we provide you, and so you'll meet the MTRS. In part 2, I'll take you through your annuity savings account and what it means to have to be a member of the retirement system. Then in part 3, Jonathan Lapriori, Director of Member Services North, is going to take you through your benefits, the eligibility criteria, creditable service, service purchases. And then in part 4, he will overview the 3 retirement options, the retirement formula, and he'll take you through some benefit examples. And then in part 5, John will take you through some ancillary issues, some other retirement issues that you need to consider before and after you retire. And as I mentioned, again, there is a Q&A feature through the app, so please use that, and we will certainly answer as many questions as we can today. Before we get into the actual program, I do want to take a minute to talk about Chapter 134 of the Acts of 2022, which was passed last summer. This is our Retirement Plus legislation, which is specifically for members who transferred into the MTRS between July 1st, 2001 and June 30th, 2022, and who, after that transfer, did not elect to participate in Retirement Plus, did not respond to the election opportunity to participate in Retirement Plus. So this new election period runs from January 1st of 2023 and will end on June 30th, 2023. So there's a 6-month election window. We're halfway through that window, and we did mail on several occasions, and we sent emails regarding eligibility. So if you did receive an election packet from us, you must elect by either sending in the information by mail or by following the instructions to make a choice online. Again, this is very important. If you received election information from us, we need for you to officially elect to participate in Retirement Plus. Otherwise, you will not be in the Retirement Plus program. I also want to stress that this election opportunity does not apply to members who either failed to elect into Retirement Plus back in 2001 or elected to not participate back in 2001. So again, this special election opportunity does not apply to those who didn't elect back in 2001 when that opportunity was given to our entire membership. I also want to talk a little bit about membership tier, because the third pension reform, which was enacted back in 2011, created a second membership tier, and we call that tier 2. And anyone who established membership with us on or after April 2nd of 2012 is now enrolled in membership tier 2. Benefits are different in tier 2. As a result of the passage of that legislation, the minimum age to retire increased from 55 to 60. The number of years used to calculate the salary average increased from 3 to 5 years, and then the age factors were also reduced. And as a result of this new benefit tier, the benefit structure is a little different. And this presentation does not apply to benefit tier 2. This presentation only applies to benefit tier 1. Now, we do have information not only in the booklet, but also on our website, which discusses both benefit tiers, makes some comparisons, and certainly I would recommend using those resources if you are in benefit tier 2, as well as benefit tier 1. But this program specifically, all of our benefit examples, some eligibility information, only applies to benefit tier 1. Now, the MTRS was founded in 1914 and is formed under Mass General Law, Chapter 32. We operate as a defined benefit plan, or what's known as a DB plan, and we operate under Section 401A of the IRS code. Everyone is very familiar with the 401k of the IRS code, but that is a defined contribution plan. So you're looking at the investments, you're trying to gain income as a result of those investments. The value of that account is really important. Well, that's not what's important in a DB plan. What's important is the formula, the retirement formula, which is based on age, service, and salary. The benefits are guaranteed for life, and the MTRS is governed by a 7-member unpaid board. We also have 2 offices, our main office in Charlestown or Boston, Mass, and of course, our satellite office in Springfield, and we have approximately 100 staff members. Now, if you are a member of the system, you are mandated to participate under law. So all public, elementary, and secondary charter, collaborative school teachers and administrators must participate in the retirement plan of the MTRS. We are the largest of the 104 contributory retirement systems in the state. We now have a total of 196,000, a little over 196,000 members, comprising of active, inactive, and retiree and survivors. Now, once you establish your membership with us, we established your annuity savings account. So that's when you first enroll in the MTRS. And throughout your career, we will maintain that annuity savings account for you. We will also process any service purchases, if applicable. We will also keep you informed of any retirement issues, any law changes, via seminars and webinars like the one that that you're attending here today. We will also provide you with broadcast emails to keep you informed of what we're doing, any changes, and in any resources that are provided to you. If you leave service before your retirement, we will refund your account upon your request. And if you pass away before you retire, we'll process any benefit to your survivors. And then during your retirement, once you retire, we will pay you a monthly retirement allowance for the rest of your life. And if applicable, we will pay a monthly benefit to your survivor for the rest of his or her life. I mentioned this already as I talked about the program booklet as being our best printed resource for information, but our best resource for information is our website. And I'm sure many of you have gone there. You can access your online MSS account from our website. There's forms. There's information regarding service purchases. Those service purchase applications can be downloaded from our website. If you want to change your beneficiary, designate a beneficiary, those forms are available on our website. We also have all of our benefit application forms. So whether it's a retirement benefit or a refund application, you can go and you'll see those on our website as well. And we have something that is very popular as of late, which is a generic retirement benefit estimator. So you can use that estimator to see what your retirement benefit may be in the future. So what happens if I decide to retire at the end of this school year? What will my benefit look like if I decide to work another couple of years? How about 5 years out? You can compare some of those figures. We always try and keep everyone up to date with any of pending legislation, other plan benefit changes. We have useful links on our website. And if you haven't already done so, you can join our email list to receive updates from us, broadcast emails from us, and that's very easy to do. So again, our best resource for information is our website. All right, so we're going to jump into part 2 here, but before we do, I want to see if we have any questions.
Yes, John, we do have a number of questions that the team is handling in the other room. But I did publish 3 questions and they're all very similar. People want to know, how do I know if I am in Retirement Plus?
Well, again, we have talked about that already as far as the special legislation and opportunity to elect. You can either call our office. You could also and ask one of our representatives to see if you are in Retirement Plus. That information is also available on your member self-service account. And you could also email us with that question, and someone on staff will investigate that, do the research, and then provide you with an answer as to whether you are officially participating in Retirement Plus.
Thank you.
All right, so we're going to move on to part 2 and talk about your membership. And once you establish membership, a certain percentage of your salary will be deducted for your contributions, and we will post those to your annuity savings account. But the amount that is withheld from your earnings is not the same. It depends on when you entered membership with us. So if you entered membership prior to 1975, then the contribution rate at that time was 5%. We don't have a lot of members who are contributing at that 5% rate, obviously, but if you entered service with us between 1975 and 1979, that contribution rate changed to 7%. And if you entered service between 1979 and 1984, not only did you contribute the 7%, but also an additional 2% on all earnings over $30,000. If you first entered membership between 1984 and 1996, the contribution rate changed to 8% on all earnings, plus an additional 2% on all earnings over $30,000. And then if you first established membership between July 1996 and July 2001, the rate changed to 9% plus an additional 2% on earnings over 30,000. And then if you establish membership after July of 2001, but before April 2nd of 2012, that rate changed to 11%, and you are automatically in Retirement Plus. There was also an election opportunity for all members to change their contribution rate from one of the earlier rates to that 11% back in 2001 to affirmatively elect to participate in Retirement Plus. And if you are a Tier 2 member, that means you first established membership on or after April 2nd of 2012. You are still in Retirement Plus. Your contribution rate remains at 11%. But after you reach 30 years of total creditable service, that rate is reduced by 3%. So your rate will change to 8% after 30 years of service. Now, throughout the presentation today, you'll see this finger with a string on it. And that is to remind you that the next time you are paid and you're looking at your pay stub, just make sure that you're contributing at the right rate. Obviously, there are many different rates here, and not only rates on all of your earnings, but with the additional 2% on earnings over $30,000, that can be confusing. And you just want to make sure that you're contributing at the right rate, working with your employer, working with us here to determine what that rate should be, because you want to avoid any surprises, anything that could hold up your retirement, and you want to correct any of those issues before they become too much of a problem. Now, not all earnings that you receive from your school district are considered pensionable, or what the law defines as regular compensation. So regular compensation defined in the law is what we'll use to calculate your retirement benefits. What is included as pensionable earnings is any annual salary per a collective bargaining that you're receiving. So your annual base salary per that collective bargaining agreement, or the base salary per an individual contract if you bargain separately. Any regular longevity that you receive from your district is considered pensionable. Any coaching that you do is considered pensionable and will be included in the calculation of your retirement benefits. Also, any annual payments that you receive for additional services that are pursuant to the collective bargaining agreement. So they have to be included and listed in the collective bargaining agreement for them to count as regular compensation, which will be used to calculate your retirement benefits. Some examples of earnings you may receive from your district, which are not included in regular compensation, so they're excluded from pensionable earnings, are such things like any amount that you receive as a result of your employer having knowledge of your retirement. So we do see across the state in different collective bargaining agreements, there may be an early retirement incentive bonus. So as soon as you give notice to your district that you're retiring, you may receive a bonus of $5,000. Well, that payment is not pensionable and will not be included in the calculation of your retirement benefits. Also very common across the state, any sick leave buyback that you may receive. And again, typically that is included in language in your contract, whether it's a CBA or an individual contract. But those earnings you receive, sick leave buyback, is not pensionable and won't be included. Any unused vacation, very similar to that sick leave buyback, that is also not included. Any hourly payments with the exclusion of breakfast or lunch duty. So breakfast and lunch duty payments, which are oftentimes hourly, those are included by statute, but most hourly payments that you receive are going to be excluded from pensionable earnings. Any temporary salary augmentations that you may receive. These were common back in the early 2000s, and they were often referred to as elbow plans or enhanced longevity buyout plans. Those are not considered pensionable. And likewise, pension reform also changed the law to exclude annuities and fringe benefits. Oftentimes premiums were paid for life and or disability insurance policies, and now those are not considered pensionable and won't be included in the calculation of your benefits. Okay, we have time for some more questions.
Okay, we've got a couple. First one is summer school payment pensionable?
The answer to the summer school question is no. So summer school is considered outside the normal school year, and therefore is not, those earnings you receive for summer school work are most often not considered pensionable earnings.
Next question. So you mentioned that athletic coaching stipends are included. What about academic coaching stipends?
So the regular coaching stipends are always included as regular compensation, as that is listed in the law, the statute itself. So academic coaching is quite often pensionable as well. It would depend on the language in the contract as to whether that would be included or excluded from pensionable earnings.
That's all the questions we have for now.
All right, well, now we're at part 3, and I will ask Jonathan Lapriori, Director of Member Services North, to come on up and take over from here.
Thank you, John. So I will now go over the type of benefits that we offer. We'll get into some actual calculation examples. And then at the end, I will get into some ancillary issues, things that you need to think about post-retirement. But first off, your MTRS benefits could consist of your actual annuity savings account. So you're putting in all this money, it's earning interest, and when you stop working, you may decide that you may want to just take a refund or roll that money over instead of taking a monthly benefit. So that would be one type of benefit that would be available to you when you leave service. You may also leave that money on account and decide to go a certain route down the road. We do offer retirement benefits, which would be a monthly payment. It could be in the form of our 2 superannuation retirement benefits. So you may qualify for a retirement benefit under the regular retirement formula. You may also qualify for a retirement plus benefit if you're participating in retirement plus and meet the eligibility criteria. We also have 2 types of disability retirement benefits, one being an ordinary disability benefit, or you may qualify for an accidental. And last but not least, you may qualify for a termination retirement benefit. It carries its own specific calculation, but keep in mind that a termination retirement benefit is only applicable to Tier 1 members. And again, I'll get into some examples and some calculations so you can see how these different types of benefits actually work. And we also offer in-service death benefits. So if you were to pass away as an active member, there are different options that a survivor could possibly fall under. And I'll get into some examples with those as well. If you do decide to take a refund and you resign voluntarily and you have less than 10 years of creditable service, you'll receive interest at the rate of 3% on your total deductions, and that interest rate is compounded annually. If you have 10 or more years of service credit and you decide to take a refund, you'll receive interest at the regular rate of interest. If you're involuntarily terminated and you decide to take a refund at that point, then you'll receive interest at the regular rate as well. In all cases, you need to keep in mind that you will only receive interest for the first 2 years of inactivity. So if you stop working and you're no longer contributing to our system, and you decide to take a refund 5 years down the road, just keep in mind that you will only receive interest on the first 2 years of being inactive. So keep that in mind if you're considering taking a refund. Further, when it comes to taking a refund, you have to remember that if you take a refund and you come back into our system, you'll be subject to the benefit structure that's in place when you do come back. So if you're a tier 1 member, meaning you established membership before April of 2012, and you take a refund and then later come back, you will now be considered a tier 2 member. Now, the benefit structure as a tier 2 member offers, lower benefits based on the fact that the age factors are lower and they don't carry the same weight as a tier 1 age factor. The salary average goes from a 3-year salary average to a 5-year salary average. And the minimum retirement age goes from 55 to age 60. So you definitely need to consider this if you're thinking about taking a refund. Just realize what the impact could be going from a tier 1 member to a tier 2 member. Now, the 2 superannuation retirement benefits would be the first being a regular retirement benefit, and you qualify for a regular retirement benefit with 20 years of creditable service, regardless of age, or if you don't have 20 years of service credit, you're also eligible at age 55, as long as you have at least 10 years of service credit. The other superannuation retirement benefit, of course, would be under Retirement Plus. So if you're participating in Retirement Plus, you may qualify for the enhanced benefit. You qualify under Retirement Plus once you reach 30 years of total service credit. So 30 years of creditable service. That can consist of your membership service, any buybacks that you may have done. So we total everything up, and you need a minimum of 30 years of creditable service. However, 20 of those 30 years must be membership service with the MTRS or the Boston retirement system as a teacher. So of the 30, 20 of those years had to actually have been membership contributing service to either our system or as a teacher in Boston. If you do meet the eligibility criteria for the enhanced benefit, you get to add an additional 12% upon reaching 30 years. Every full year after that will gain an additional 2%. So for example, if you have 31 years of service credit, that would be 14%. 32 years would be an additional 16%, and so on. The disability retirement benefits, as I mentioned earlier, could be in the form of an ordinary disability or an accidental. Under the ordinary disability retirement, you need to have at least 10 years of service credit. We would bump your age up to the age factor for being 55. So if you're under the age of 55 and you qualify for an ordinary disability retirement benefit, we will bump your age up to 55 and calculate your benefit based on that. If you're a veteran, then the benefit is equal to 50% of your last annual salary plus an annuity portion. Under the accidental disability retirement, there are no service or age requirements. However, the disability must be due to an injury sustained while performing your job duties. The formula under the accidental disability retirement is 72% of your last annual salary plus an annuity portion, which would be capped at 75% under the accidental disability retirement. Last but not least would be the termination retirement benefit. Again, this is only for tier 1 members. There is a minimum service requirement of 20 years. The termination must be completely involuntary. And so, for example, it could be just a budget cut where the position is eliminated, or a non-renewal. it cannot be something that's due to moral turpitude. So they can't be any violation of school rules or conduct. We look at those on, very closely to see what the circumstances were that led to your termination. But if you do qualify, you get 1/3 of your salary average plus an annuity portion. On average, when you add the annuity portion in, someone usually looks at receiving mid to upper 40% range under a termination retirement. At this point, I'll stop to see if there are any questions.
Yep, we do have a couple of questions. The first one is retirement plus only for those before 2012?
The question was, is retirement plus only for those coming in before 2012? The answer is no. So if you're somebody who became a member of our system after 2012, you are automatically in retirement plus. So your contribution rate automatically becomes that flat 11%. And then if you meet the eligibility criteria by the end, you may qualify for a retirement plus benefit. You may also be somebody who had money on account with another retirement system. Again, we're the only retirement system that offers the retirement plus benefit. So if you transferred in from another retirement system, you would have 180 days to elect into retirement plus. If you do end up electing in within your window, then you could be in retirement plus, and then you'll just have to see if you meet the eligibility criteria by the end.
Right. Another question, actually two questions, I'm going to combine them. Is there a distinction between teacher and principal? And does teacher also mean administrator, or is it strictly a teacher?
Okay, so I think as far as qualifying for retirement plus, our members consist of teachers, administrators, guidance counselors. There are a number of different eligible positions. All of those positions, upon meeting the eligibility criteria, would all be considered gaining service credit and would qualify for a retirement plus benefit. So it's not just applicable to teachers only. It would be anyone who's a member of our system.
All the questions for now.
Okay, thank you. So earlier, John went over the retirement formula, and service credit is one of the three major components that make up the retirement formula. And so full-time service credit, someone working on a 10-month basis, I'll use teachers, for example, who are working September through June, every 10 months of service credit would grant you 1 year of service credit. Administrators typically have to work, they have a 12-month work year. So if you're somebody whose contractual work year is working 12 months out of the year, you're working year round, then your full year of service happens after you've worked 12 months. Leaves of absence, the service credit depends on whether it's paid or unpaid. So if you're on a paid leave of absence, your service credit is proportionate to the amount of your full-time salary you're receiving. So if you're on a 50% paid leave, then you would be receiving 50% service credit for that time period. Any unpaid leave of absence, you can get up to a full month of service credit for an unpaid leave. So you may be on an unpaid leave for 1 month, 2 months, 6 months. You can get up to a maximum of 1 month of service credit for each unpaid period. And at the end, we're going to use full years and full months of creditable service, and we're going to use that total in the retirement formula. Not everyone works on a full-time basis throughout their whole career. Folks could go from part-time to full-time back to part-time. When we talk about part-time membership service, you may be entitled to full-time service credit for your part-time membership service. Anyone who was a contributing member on a part-time basis on or before November 9th of 1990 will automatically receive full-time service credit for your part-time work. Again, this is contributing membership service. The second category, the dates that we look at is service rendered between November 9th of 1990 and July 9th of 2010. If between those dates, you were working and contributing as a part-time member and never went to full-time between those periods, you would be somebody who would automatically receive full-time credit for your part-time work. So the key is that you never had a status change between those two dates to full-time. So as long as you remained contributing on a part-time basis between those dates and never went to full-time, you would be entitled to full-time service credit between those dates as well. However, any part-time membership service rendered on or after July 9th of 2010, you will always receive prorated service credit. In addition to regular service credit, where you're working and you're contributing and paying in through your job, you may also be eligible to buy back time and add to your total service credit. We do have a number of different types of service purchases that you can do. For example, a refund buyback. So if you were a member of our system at one point, left service, took your money out, when you come back to membership service, you're eligible to buy back that time. You may have mass public employment. There's eligibility criteria for each of these, but if you are a public employee in mass, you may be able to buy back time and apply it to your total years of service credit. Substitute service, it's a very common buyback. So you may have been a substitute service prior to your membership period with us. You could buy that time back. Out-of-state public school teaching. Non-public school teaching before 1973. Obviously with that, it's a rare buyback given that it had to have been rendered before 1973. That type of service would be your traditional, parochial school service. You may also be eligible to buy back your Department of Defense overseas dependent teaching service. Those types of buybacks carry an interest rate that's currently 7%. So it's the full actuarial rate of interest. We also have other types of service purchases, such as military service. If you qualify as a veteran in the Chapter 32, you could buy back up to 4 years of your active duty. You may have worked in a non-public school where the student's tuition was at least partly paid by the Commonwealth. That would typically be your Chapter 766 schools. If you have teaching service rendered in those types of schools, you may qualify for buyback there. Any vocational service you may have rendered, if you've ever earned your Chapter 74 licensure and had prior vocational service, you may qualify to buy that up to 3 years of that service. And last but not least, you may qualify to buy back any Peace Corps time you may have rendered. These 4 types of service purchases carry a lower interest rate when buying it back, which is half of the actuarial rate of interest. So currently, the interest rate with those 4 types of buybacks would be 3.5%. Now, if you think that you qualify for any of those types of buybacks, you want to visit our website at mass.gov/MTRS and find the applicable service purchase form. So you would need to complete a section of that form along with your employer at that time. So you would need to complete your part of the form, send the form off to the employer at that time, get the form back from the former employer and mail it into our office. And at that point, we'd review it and determine whether or not you're eligible to buy back that time based on the applicable criteria. And we would actually send you an invoice letting you know how much service credit you're eligible to purchase, along with the cost associated with that buyback. Typically, the cost would be based on the earnings you received during that period of service. So we would figure out, had that service been rendered as a member of our system, what would you have paid in to our system? So that would become the principal amount. And then, of course, the applicable interest would be tacked on top of that principal amount to get your total amount owed. The different options that you have to pay for that service, if you do get an invoice, you can either pay with a personal check, or we do accept pre-tax rollovers or transfers from other eligible plans, such as a 457, a 403B, an IRA. So people do take advantage of the pre-tax rollovers rather than coming out of pocket. So you do have some options when you're buying back time. Any service purchase that's $1,000 or more, we do offer a 5-year installment plan. And the installment payment amount is right on the invoice. So we would be showing you what the amount due is if you were to pay it in one lump sum. And the invoice would also show you what the annual installment payment would be along with the applicable due date for that. You do want to remember that all buybacks must be paid in full prior to your date of retirement. So you don't want to wait until the last minute to apply for these different types of service purchases. You want to do them well in advance. Some other reminders when it comes to purchasing service: you must be an active member at the time that you apply to buy back the service. There are, however, 2 exceptions, one being Peace Corps service and the other being a refund buyback. So these are the only 2 types of service purchases where you would actually be able to apply as an inactive member and still qualify for the service purchase. But all other buybacks that I covered, you need to be an active member at the time of application. And once again, all service purchases must be paid in full prior to your date of retirement. If you apply late and still active, but you're applying late in the game, that could delay your first benefit payment, and it could also have an impact on your actual retirement date. So do not wait until the last minute to apply for these buybacks. So now I'll take you through the 3 benefit options that you will actually get to choose from at the end when you do decide to retire. The first is option A. Option A is the maximum allowance. However, there are no survivor benefits under option A. Option B is typically 1 to 3% less than option A. There is a survivor benefit in the form of a lump sum payment of the remaining balance of your annuity savings account at the time of death. You can name anyone as a beneficiary under option B, and you can name more than one person. So again, the lump sum payout becomes the survivor benefit, assuming there's still something left in your annuity savings account. So it's essentially like a decreasing term life insurance policy. It's probably the best way to look at option B. Over time, that money will deplete. However, if there is money left on account at the time of your death, it's a one-time payout to your survivor or survivors. Last but not least is option C. On average, about 9 to 11% less than option A. You are restricted, however, as far as who you can name as a beneficiary. It can only be one person, and it has to be limited to either a parent, child, sibling, or a spouse. And the survivor, upon your death, receives a monthly retirement benefit equal to 2/3 the amount you were receiving at the time of death. And that monthly benefit continues for the rest of the survivor's lifetime. There is a pop-up provision with option C. So if you take option C and your beneficiary were to predecease you, at that point, you would pop up to option A. You don't rename an option C beneficiary. We just bring you to the option A calculation at that point forward. So the retirement formula is the age factor times your creditable service, which gives you the percentage of your salary average. If you qualify for the Retirement Plus Enhanced Benefit, you would add the additional percentage on top of your regular percentage, multiplied by your 3-year salary average, gives you the option A benefit. If you qualify as a veteran, you could be entitled to an additional $300 per year. This formula gives you the option A amount. So let's take a look at someone who is retiring at the end of this current school year. So June 30th, 2023. This person is not participating in Retirement Plus. They're 59 years old at retirement with 35 years of total service credit. And as you can see, they had 30 years of regular service credit. She purchased 4 years of out-of-state service. She had 4 months or 0.4 years of subbing. And she also had 6 months or 0.6 years of Parks and Rec time. Everything totals up to 35 years of service. Her highest 3 consecutive years gives her a salary average of $75,000. And she's also a veteran. So how does that play out with the retirement formula? Well, the age factor for a Tier 1 member at age 59 is 0.019 multiplied by her total years of creditable service, gives her 66.5% of her $75,000 salary average. That brings her to an option A annual benefit of $49,875. And because she does qualify as a veteran, she gets an additional $300 per year, bringing her gross monthly benefit under option A to $4,181 per month. Option B, once again, is a little bit less than option A. And the difference actually comes from the annuity portion of someone's benefit. So in this particular case, her option B benefit is about $468 per year, which falls in between that 1 to 3% range reduction. Not everyone's option B reduction is going to be the same, however, so just keep that in mind. It does depend on your total account balance. It also could depend on the age at which you retire at. So we just give an estimation that it's 1 to 3% less. But if you are looking at option B and you're sort of close to retirement and you're not really sure what that percentage difference will be, you can certainly contact us and we can kind of help you get to a closer figure on your option B allowance. But in general, it's about 1 to 3% less. Option C. In order to calculate an option C benefit, we use what's called an option C factor table. Now with option C, we are using this table and we are looking at your closest age at retirement in relation to your beneficiary's closest age at retirement. And we use this chart, and where the two closest ages intersect, that determines what the option C factor is. So in this particular case, although the member was 59 years old at retirement, her closest age is actually 60. So we would find the member's closest age on this chart, as well as the beneficiary's closest age, which is 59, and where the two closest ages intersect equals almost 91%. So the option C factor in this particular example is 0.9099. So simply we start off with the option A annual benefit of $49,875 per year times the option C factor of 0.9099 to give us her option C annual benefit of $45,381. Once again, she is a veteran, so we include the $300 to give her her final option C annual allowance of $45,681, which would give her $3,807 per month as a gross monthly benefit. A survivor, upon her death, would receive 2/3 of that amount, which would give the survivor a gross monthly benefit of $2,538. Now let's take a look at somebody who is in the Retirement Plus program and who actually qualifies for that and meets the eligibility criteria. So this particular person, also retiring June 30th, 2023, is 58 years old at retirement with 34 and a half years of service credit with a salary average of $75,000. This person is also a veteran. So we start off with the regular retirement formula calculation, where we take the age factor for 58, which is 0.018, times his 34 and a half years of service credit, gives us a base percentage of 62.1%. Now, because he is a Retirement Plus participant with at least 34 years of service credit, he gets to add an additional 20% on top of his regular retirement percentage. However, we do have to cap the benefit at 80%, but because of being in Retirement Plus, this person goes from 62.1% to the maximum of 80% of his $75,000 salary average, which would give him an option A Retirement Plus benefit of $60,000 plus the $300 vet bonus, gives a total option A annual allowance under Retirement Plus of $60,300 or $5,025 per month. I did mention earlier that we do offer in-service death benefits. So if you were to pass away as an active member, you may be providing a type of survivor benefit to your survivor or survivors, and it depends on the type of beneficiary you have them listed as. Everybody at this point should have completed a beneficiary form designated someone as a beneficiary under either a lump sum beneficiary or a member survivor beneficiary. So if you list somebody as a lump sum beneficiary, that person would receive a lump sum payment of the balance of your annuity savings account at the time of death. And like option B, you can name anyone or more than one person as a lump sum beneficiary. On the other hand, in order to name someone as a monthly member survivor beneficiary, it has the same restrictions as option C has if you were to choose option C in retirement. So you want to look at a member survivor beneficiary like an option C beneficiary, where it's limited to a parent, child, sibling, or a spouse. That person, if under the age of 55, passes away. So if you have, as the member, is under the age of 55 at the time of death, we would bump your age up to 55 and calculate your benefit as if you were 55. If your beneficiary, we would also bump your beneficiary's age up the same number of years and months it took to get you to 55. And we simply calculate an option C benefit. Unlike taking option C in retirement, where your survivor gets 2/3 that amount, your survivor, your member survivor as an active death, gets the full option C calculation. So there is no 2/3 reduction. So we use your date of death as your retirement benefit. We would calculate the option C benefit, and that is what your survivor would receive as a member survivor benefit. If there are dependent children, then the oldest child would receive $120 a month, and the other children, if there's more than one, would receive $90 per month. These monthly payments go to dependent children up to the age of 18 or to the age of 22 if they're a full-time student. So you want to make sure that you have a beneficiary form completed. And if you're not sure whether or not you've done that, you can certainly contact us. We'll be able to look up your information and we can tell you who has been designated as a beneficiary, as well as what type of beneficiary they're listed at. If you need to complete a new beneficiary form, you would simply just go to our website, download the form, complete it, and submit it. At this point, are there any questions?
Sure, got a couple of questions. The first one, it doesn't contain a lot of context, but it did come in when we were talking about purchasing service. And the question is simply, how about paras?
Okay, it's a great question. Someone who rendered service in Massachusetts, in a Massachusetts public school as a paraprofessional, so that could be your, tutor service or aid service. That is definitely a type of service that's eligible for purchase. So you would want to be downloading the substitute temporary part-time service purchase form from our website to document that para service. Some people as a para may have been paying into another mass contributory retirement system. So that service may have transferred over to us. Maybe you took a refund from the other retirement system, or maybe it was non-membership service. But either way, if you rendered service as a para in a mass public school, there's a very good chance that that service would be eligible for buyback.
Great. This question is specific to buying back state service, but I think it's a good question that would apply to all buybacks. Can you figure out what the cost of purchasing service would be before committing to the buyback?
So we can certainly, just because we send you an invoice. So if you submit a service purchase form, we send you an invoice, so it's eligible, we send you a bill. You are not obligated to pay for that service. So it never hurts to apply for service, get an invoice. We're just simply telling you how much it's going to cost as of a particular due date. It's up to you whether or not you want to purchase that service. So you're not obligated to buy it. If you decide to let the due dates pass and you want to purchase that service down the road, you would just simply request an updated invoice and we'll send you a new invoice at that point in time.
Next question. I didn't see anything about contracted services. If you were hired by a district through a contracted company and subsequently was hired by the district, can you buy back that time?
That's a great question. We oftentimes have service documented as a contracted employee. Those are a little tougher, that type of service, because what we have to look at is who controlled the employment. So rather than getting into all the specific details on service rendered as a contracted employee, typically we see that with our OTs and PTs, our physical therapists and our occupational therapists, where you're rendering service and you're billing a school district for your time. It's just safer to have that service documented. When we receive that service, there are several questions that we would need to follow up on with the district. And then we would make a decision at that point in time. So that's a tough one to give a definitive answer on at this point.
Couple more. Excuse me. My member self-service creditable service estimates report does not show credit for 1993 to 2010. Is this something that I need to be concerned with?
That's a very good question, and it's a common question. So as most of our members know, they can log into their member self-service accounts and run a credit service report. We did put an algorithm into our system that attempts to calculate someone's service credit based on their contribution history. However, it's not a perfect science, and it doesn't work for everyone. So it is not a reason for concern if there is no service credit showing up, or it just doesn't look right at all. You would just want to simply contact us. We can take a look at that service credit, and in most cases, we can correct it. You can also complete a creditable service purchase application. You're filling out an application and submitting it, and we will actually go back into your account and do some detailed research on what your actual service credit should look like, and we would actually send you a breakdown. So you should not be alarmed if in your MSS account it doesn't look right. It doesn't mean that we don't actually have the service credit or the deductions. It's just something that you can't completely rely on at this point, but we can certainly help you get to that right number.
One more. Can you change your retirement options once you are retired, or do you need to stay with the option that you chose at the time of retirement?
That is a great question. So as part of the retirement application process, right in part one of the application, which is the part of the application that you will be completing, you're actually choosing your option. You have up until your retirement date to change your benefit choice. Once your retirement date passes, you're technically locked into the option that you chose. So you want to be very careful. If you have any reservations, you just want to, be careful that you're not waiting until after your retirement date to attempt to change your option, but you are able to change that up until your effective date of retirement.
That's all the questions for now.
Okay. So part 5, I'll just touch upon some things that you want to think about immediately prior to retirement, and just be up on top of, as you enter your post-retirement period. The first thing is know what will happen with your health insurance. So about a year before you retire, you really want to have a good handle on how your health insurance will be administered. Some of you, depending on the school district that you're retiring from, will be part of the Retired Municipal Teachers Program, which is through the Group Insurance Commission. Others, whose district is not a RMT program participant, will remain, in most cases, with the city or town that you're retiring from. So you want to contact your insurance coordinator at least, about a year in advance. Ask the questions, what will happen to my health insurance once I retire? You also want to find out whether or not, if you end up qualifying for Medicare at 65, does your school district offer a supplement to Medicare? What happens to a survivor upon your death in retirement? So if you're carrying somebody with the retiree health insurance and God forbid you passed away, what happens to your survivor's health insurance benefits? Do they get to continue the coverage? How much may it cost? Once you do sign up for your health insurance plan, those premiums will automatically be deducted from your pension check each month. And lastly, before your 65th birthday, you want to contact Social Security to determine your eligibility for Medicare, and you want to find out when you need to apply for Part B. You don't want to run into an issue where you're applying late and have to be subject to any type of a penalty. So the health insurance obviously is huge in retirement. So do your homework up front. Again, we recommend to do that about a year from retirement so there are no surprises when the time comes. Working after retirement kind of sounds like an oxymoron. However, it is such a common question that we get on a daily basis from our retirees. They're looking at continuing, to do something else. You want to remember that there are no limits whatsoever with post-retirement employment in the private sector, in another state, whether it's public or private, or employment within the federal government. So in any of these scenarios, you're able to continue receiving your normal pension benefit, and you're not subject to any limits whatsoever. You want to be careful, however, if you're going to be reemployed in the mass public sector. So any mass public employment will make you subject to the restrictions and to the limitations. If you're returning to the same employer from which you retired, there is a 60-day window. So you must be separated from service for 60 days before you're able to go back and work for that same employer as a retiree. We can waive that 60-day window, however, if you retired at age 62, or you are eligible for 80% at retirement. So if you retired at 62, or you retired at 80%, you will not have to worry about the 6-day window if you're going back to the same employer from which you retired. There are 2 restrictions in mass public employment. and the first is an hourly restriction per calendar year. You cannot exceed 1,200 hours of employment in a calendar year. So that's the time restriction. It's a maximum of 1,200 hours. There is also a earnings restriction, and it's whichever one you hit first. So you have to be mindful of the time and earnings restriction. Now, with the earnings restriction, your post-retirement earnings cannot exceed the difference between the salary being paid for the position from which you retired and the amount of your annual pension benefit. So you're able to make up to the difference between the two. And then after being retired for one full January through December calendar year, you're able to add $15,000 to your earnings limit. Now, I'll show you an example to illustrate it. Here's somebody who's retiring June 30th, 2023. The following school year comes around, and they're thinking they want to go back and work, but they know they have to figure out what their earnings limits are. If they were looking to go back to work for the 23-24 school year, they would need to find out, had they still been employed in their former position, what would their current salary be? So in this particular case, this person, had they returned to service the following school year in that same position, she would have been earning $79,000 per year. She knows that her annual MTRS pension benefit is $50,175. So the difference of $28,825 becomes the limit. So it is a pretty straightforward calculation. So again, you need to find out at the time you're going back to work what you would have been earning had you remained in that same position, subtract your annual pension benefit to get the annual allowable income. And then for this person, beginning January 1st of 2025, she would be able to add an additional $15,000 to that $28,825. So that would be the formula for the earnings limits if you're reemployed in mass public sector. Now, some people can avoid having to deal with the restrictions if they are working under what's called a critical shortage waiver. Keep in mind that anyone who retired as a retirement plus person, you have to wait 2 years before you're eligible to work under a critical shortage waiver and have no limits, whether it be the earnings limit or the hourly limit. If someone does qualify to work under the 1-year waiver, there are no restrictions whatsoever. So the earnings restrictions and the hourly restrictions go out the window. These waivers are good for 1 year. So the school district each year would have to reapply to the Department of Elementary and Secondary Education for these 1-year waivers. And again, if you qualify to work under the waiver, in this instance, there would be no restrictions. Regarding the taxation of your retirement benefit, as long as you're living in Massachusetts as a retiree, you are not subject, your pension is not subject to the Mass state income tax. It is, however, subject to federal tax. And when you apply, your Part 1 of the retirement application will include a W-4P form. So you would be completing a W-4P to tell us how what your federal tax withholding is. So you do have your federal tax withholding. You are subject to that. Some of you at retirement will have after-tax money in your accounts. So you'll have an after-tax total of your annuity savings account. Anyone who has after-tax money in their account will have a reduced taxable portion of their gross annual benefit each year. Taxable contribution, after-tax money would consist of your retirement contributions made prior to January of 1988, or if you did do a service purchase and made a payment with a personal check, that would be added to your after-tax total. So those of you that do have an after-tax total in your account at retirement, you will get a slight reduction on the taxable portion of your benefit each year. If you intend to move out of state, you want to check with that state's Department of Revenue to see whether or not that state will actually tax a mass public pension. You will receive a tax form from us each tax year as a retiree. It's called a 1099-R. It's the equivalent of what you receive while you're working now, which is a W-2. So by the end of January of each year, as a retiree, we will be mailing you the 1099-R form so you can do your taxes. And in addition to that, every other year, we also will be sending you a benefit verification form to make sure that you're still alive and eligible to collect the benefit. So every other year, along with the 1099, you will also receive this benefit verification form. So be on the lookout for that. Social Security. Some of you may qualify for your own Social Security benefit. For those of you that will qualify for your own Social Security benefit, you need to be mindful of the windfall elimination provision, or otherwise known as the WEP. You would be exempt from the WEP if you were eligible to retire from the MTRS prior to January 1st of 1986. So you're always eligible to collect your own Social Security benefit, but if you're not exempt from the WEP because you weren't eligible to retire before January of 86, Social Security will apply a reduction formula to your Social Security benefit. So the other way to be exempt, other than if you weren't eligible to retire before January 1st of 86, you would be exempt from the WEP if you had at least 30 years of substantial earnings under Social Security, which is very difficult for most of our members since you're not paying into Social Security, as a teacher. So someone who had prior private service or continued some form of private service, over the years, you may have 30 years of substantial earnings. If so, you'd be exempt from the WEP there. On the other hand, some people qualify for a spousal benefit under Social Security. However, it's very, very difficult to qualify for a spousal benefit under Social Security due to the government pension offset, or the GPO. You're eligible, or you're exempt from the GPO if you were eligible to retire prior to December 1st of 1982. So obviously, incredibly difficult to be exempt from the WEP. It doesn't necessarily mean that you're not going to receive a spousal benefit under Social Security, but it is very difficult due to the 2/3 reduction formula that Social Security will apply. So they will look at 2/3 of your monthly teacher's benefit and match it up against that spousal benefit that you would normally be eligible for. If 2/3 of your teacher's benefit is more than what you were entitled to as a spousal benefit under Social Security, then unfortunately your benefit would be null. You would not receive anything through your spouse. If 2/3 of your teacher's benefit is less than what you would be entitled to through a spouse, then you would be able to receive the difference. So it's very rare that somebody would qualify for the spousal benefit under Social Security. But these are the two double dipping laws that you need to be aware of. We're now, I believe, at the end of the presentation. However, before we end, I just want to quickly cover the cost of living adjustments. Someone has to be retired for at least one full fiscal year before they become eligible for a COLA. The COLAs are not guaranteed year to year. They're actually part of the legislative process. So they have to be granted by the Mass Legislature when they approve the budget each year. So they're not guaranteed. However, if they are approved, the current COLA is 3% on the first $3,000 of your retirement allowance, or the CPI, whichever is less. So right now, the maximum cost of living adjustment is $390 per year, or $32.50 per month. So with that, I'd like to conclude the presentation and thank everyone, and we'll stick around for some questions.
Great. Do you have a couple of questions in the chat? The first is about beneficiaries. Can I list my estate as the beneficiary and not just one person?
So it's a great question. The only type of, now, is this as an active member or retiree? Was there a distinction?
Doesn't
Okay.
say.
So an estate can be listed as a lump sum beneficiary as an active member. You can list an estate. Also, under option B, if you retire and take option B, you would be able to name an estate as the beneficiary, but you would not be able to name an estate as a member survivor beneficiary as an active member, or as an option C beneficiary. But as a lump sum beneficiary, yes, you would be able to do that.
One more on beneficiaries. Can I change my beneficiaries at any time?
So if you're an active member, yes, you can change your beneficiaries at any point in time prior to retirement. So you can change the type of beneficiary you're listing, who that beneficiary may be. However, if you retire and you take option C, you are not able to change the beneficiary after retirement. However, if you retire and take option B, yes, you could change a beneficiary. So it depends on whether you're an active member or you're actually retiring. And if you've named an option C beneficiary, that person is locked in as the beneficiary unless they were to predeceased. And at that point, again, that you would just jump up to option A at that point.
You just covered this, but I think this is the question that a lot of people have. Does the annual retirement allowance adjust each year for inflation? $45,000 per year today will be the equivalent of pocket change in 20 or 30 years.
Well, the answer, unfortunately, to that question would just, any increase would be in the form of the cost of living adjustments. That's all we're looking at this point. It's the only way that your benefit would increase. Subject to the legislature in their vote as to whether or not each year they're going to pass a COLA. So that would be the only increase someone would be looking at.
Next question is about Social Security. I had 10 years in private schools before my 26 years in the MTRS. What happens to the Social Security I paid before? Can I get both?
Well, you need a minimum of 40 quarters or 40 credits in order to qualify for your own Social Security benefit. So somebody with only, well, it depends. Actually, 10 years of service credit would get you the 40, could get you the 40 credits. So as long as you have at least the 40 credits, you would be eligible for a benefit under Social Security. Because typically, yes, after 10 years of working in Social Security, more than likely you would have the minimum number of credits. It might not be the full amount that you would normally be entitled to, had it not been for your MTRS benefit, but you would be eligible for something. I believe the maximum reduction in 2023 is about $550, $560 would be a maximum reduction, but they would calculate that, at the time you go and file for that Social Security benefit.
And if people wanted to see how many Social Security credits they have, they can do it at the Social Security website.
They would want, well, they should be getting a statement each year from Social Security that actually breaks down the number of years. They would also be able to go onto the website and set up an account that would probably be able to show them what, where they stand presently with Social Security.
Great. This next one is about insurance. If I stop teaching after achieving 30 years of service credit, but don't file retirement right away, so my age factor increases, how will health insurance work upon retirement? Will I still be through the town where I last taught once I do actually retire?
That's a great question. And the answer, it varies from city or town. So it's not an across the board, there's no across the board answer on that. So that is a great question for the insurance coordinator in that city or town they're working in. Because if you're not retiring and actually filing for retirement benefit and taking the retiree insurance right away, it's possible that some cities or towns may have their own, rules on that and may or may not let you pick it up down the road. So that's a question for the school district.
One last question that's been published into the Q&A. When you mentioned the 3 highest years of earning, is it the most recent or can it go back to previous years?
Okay, so when we talk about the 3-year salary average, it does not necessarily have to be someone's last 3. We'll look at any 3 consecutive years of earnings to determine a salary average. Somebody could have been an administrator, and then finished up as a teacher. They may have switched school districts at some point. So we're going to look at wherever the person's 3 highest consecutive years fell, not necessarily the last 3.
That's all the published questions we have. We do have a lot of questions being asked in the Q&A, but our representatives in the next room are handling those and working through them. So that's all the published questions I have for now.
Thank you.
Great.
Right. Thank you. Thank you very much. Thanks for attending, everyone.